Hello, everybody. Um, yeah. Hello. How are you all? Hope you're all having a lovely day. And let's talk about Bark. Ticker Bark. This company closed on Friday at $1.58, and that's off its 52-week high of $5.56. It has a 1-year target of $6.50. And let's read this article and see if it's a buy. This article comes from Seeking Alpha. Bark shares have jumped as much as 120% since I last covered the company in June. The company reported better than expected profitability results in its first quarter. The business is still losing money, and this investment is highly speculative. But I think that the company's outlook is moving in the right direction. I still think that Bark shares have considerable upside potential if the company manages to reach profitability. Bark's business model is straightforward. The company sells its line of branded products to dog owners. Most of its sales and through its direct-to-consumer subscription boxes. This model is simple and consistent. The company has clear profitability drivers. It has to license the average revenue per customer and reduce customer acquisition costs. Oh no, it has to increase the average revenue per customer, not license. Bark reported a $13 million adjusted EBITDA loss in the last quarter. This beat its previous guidance by $5 million. The company grew its average order value by 7% year over year and 3% quarter over quarter. A lot of this is due to management's focus on the higher margin products. Products like Bark Eats and Bark Bright generate more profit for the company. Bark's subscription business is reporting strong fundamentals. Management reports that their customer acquisition costs have not increased. However, the company has seen strong growth from newly acquired customers. The average revenue generated by new customers has jumped 10% since last year. At the same time, management is trying to keep expenses under control. The company's operating expenses grew by 18% year over year compared to 12% top-line growth, but management has cut operating expenses by 10% over the last 2 quarters. They discussed the company's expense growth on their last earnings call. The year-over-year increase was primarily driven by a 6% increase in subscription shipments in the most recent quarter and increased headcount looking ahead. Headcount. I always do that. Looking ahead, we do not have any plans to materially increase headcount from current levels. We expect the majority of G&A growth this year to be driven by subscription shipment volume, and thus we expect our operating margins to improve in fiscal 2023 as compared to fiscal 2022. I think that this is a solid outlook. The business is continuing to report positive top-line growth. Bark's hiring freeze will let more of the company's gross profit flow through to the bottom line. Because of this, management expects the company's EBITDA loss to narrow to $8 million in quarter 2. This would be a 38% sequential decrease. Overall, I think that the company's profitability outlook is quite positive. There is still a long way to go, but all of Bark's major metrics are moving in the right direction. The valuation is still discounted. Even after a 32% bounce off its lows, I still think that Bark shares are cheap. The company has a price-to-book value of 1.4 times. Its market cap is about $300 million. It has $177 million in cash on its balance sheet, offset by $76 million in debt. This gives the company an enterprise value of just $190 million. This seems low for a company with over $500 million in annual sales and the potential for solid margins. The company has $158 million in inventory on its books, up 54% since last year. This is over 8 months worth of inventory. This seems high for a company with this profile, but I don't think it will be an issue due to Bark's business model. Management discussed their inventory outlook on their earnings call. We continue to hedge against potential supply chain disruptions. However, we do not believe that inventory will be a material drag on working capital this year, and we expect our inventory to come down from current levels as we leverage the products we have on hand over the next several quarters. It takes time for us to turn this as we are typically ordering products 6 months in advance. So we'll take a couple quarters to see our progress reflected on our balance sheet. But one great thing about our subscription model is that the customer is unaware of the products they will receive in their Dogs and Trend. In a traditional retailer e-commerce business, the customer selects the exact products they want sent to them. In our model, it's a surprise each month, and we can leverage the inventory we have on hand at our discretion. This inventory model is very efficient. It effectively eliminates the chances that Bark will have to take large markdowns. This should allow the company to maintain its solid margins above 50%. The company is reducing its cash burn rate. In the last quarter, the company spent $17.4 million on its operations. This cost is down by almost 70% since last year. At the current run rate, the business has enough liquidity to sustain itself for over 3 years. It's difficult to value a company with this much uncertainty, but shares are trading at a forward EV to revenue of 0.34 times. So it appears the market doesn't think that Bark will be able to reach profitability. I think that there is a good risk to reward that the company will become profitable. Even modest margins would make the company's shares undervalued, in my opinion. Bark is continuing to grow its top line even as economic headwinds increase. The company reported 259,000 net new subscribers in the last quarter. I think that Bark can continue to sustainably add subscribers. Spending on pets typically stays consistent through recessions. Yes, that is true. Just like me, I all the money I spend is for my dog. So it's all recession proof. All right, back to the article. Sectors such as pet food and healthcare are especially resilient. Bark Bright and Bark Eats are fast-growing offerings in these categories. I also think that Bark has good opportunities to sell new products to existing customers. The company generated $10 million from cross-selling in quarter one. This is up 42% since last year. Management has been integrating all of Bark's offerings into a single site. For example, the company started cross-selling Bark Bright products and food toppers to its toy and treat customers in May. This boosted the company average order value. It also decreased its customer acquisition costs. So, with Bark trading at $1.58, I think it is a absolute buy. That is my opinion. Let me know what you all think, and I hope you all have a lovely, blessed day. See ya.